Hello, and welcome to the Dr. Money Matters podcast, the show where we discuss important financial topics that were never covered in med school. I'm your host, Dr. Tarang Patel. Welcome to episode 3 of the Dr. Money Matters podcast. Our guest today is Ike Devji, an attorney in Phoenix, Arizona, who specializes in asset protection for the past 14 years. Ike's spoken to a lot of physician groups and written many articles in medical magazines for a variety of specialties, including diagnostic imaging, Psychiatric Times, OBGYN.net, amongst many others. In addition, Ike has been featured in the Wall Street Journal and also listed in Worth Magazine's leading wealth and legal advisors. Good morning, Ike. How are you?
Good, thank you. It's a pleasure to be with you this morning.
Thank you. Thank you for coming on the show. Going to talk to you today about asset protection. So actually, before we do that, though, tell me a little bit about yourself, Ike, and what you've been doing. I kind of mentioned a little blurb about you, but please go into more detail.
Oh, sure. Thank you. Well, as you said, I am an attorney. My practice is exclusively limited to asset protection planning, and that planning includes several thousand physicians that my partners and I protect across the United States, in every state. We also protect several thousand higher net worth private business owners. I formerly managed the largest asset protection only firm in the country, which I'm still of counsel with, Lodmell & Lodmell. And basically, our job is to help people manage their risks, identify their risks, figure out what assets are exposed, and take the reasonable steps that we can to protect those assets before a problem arises, which is the only time that we can actually act on these things legally.
Okay, so in terms of asset protection for physicians or dentists or healthcare professionals, what is it specifically, and why do we need it? Are we not protected by our malpractice insurance?
Well, sure. That's a great question, and I'm glad we're starting there. I think that'll create a good base for your listeners. Asset protection is actually a combination of many things. I think the best way to describe it and the most accurate way to describe it is to think of it in terms, in the same kind of terms, for instance, that physicians describe wellness as a lifestyle. It's a combination of things. So first and foremost, it's what we would refer to as compliance, or the euphemism I use when I teach CME on this issue is clean living. It's first not doing things or avoiding or controlling risky behaviors and liabilities that can create risk and exposure. That's the first layer of asset protection. The second layer of asset protection is a comprehensive insurance program, not just a single policy. We can talk about that in some greater detail as well. But it's having all of the right kinds of insurance to the right amounts. And then finally, the third and final layer of asset protection is legal tools, having the right legal structures in place that segregate your personal and professional assets and the risks that they create and are exposed to. If we can do all three of those things, we can have a formal asset protection plan in place. And I think first and foremost, and I'm going to repeat this over and over because it's a very common error made by physicians in particular, asset protection is proactive. It is preventative planning, and it cannot be implemented after a crisis occurs.
So that's an important distinction, because normally we don't think about these things until we're in a bad situation. And obviously, like you said, it's wellness, preventative. So it's better to start early before you have any issues and prevent these issues in the first place. So let's get into a little bit more specific. So let's say, physicians, we all carry malpractice insurance. If I'm sued for malpractice, the big concern is, I have the insurance. Am I protected for anything beyond the malpractice? It seems like malpractice, generally, most physicians carry a $1 million policy for each incident and a $3 million total coverage. Is that not enough? What should I be worried about there?
That's a very important issue to discuss. You're correct. Most of the physicians that I talk to nationally almost universally have that 1-3 policy in place that you refer to, which is $1 million per occurrence, $3 million aggregate. So that is a great start, at least on your professional liability. and having that coverage in place. But even in a relatively conservative state like Arizona, for instance, where you and I happen to be sitting, if we look at the top 10 civil verdicts of 2015 in this state as one example, just this state's top 10 civil verdicts included 3 verdicts in excess of $5 million that were medical malpractice claims. Now, if we think about that for a moment and think about the fact that even if your med mal carrier paid out the max of your policy limits, that would still leave that person, that practice, and the physicians that are also personally named in these suits. Remember that corporate shell is not going to protect you from a professional liability claim if you are the care provider. You will also get to go to that dance. That leaves you out of pocket for the $4 million exposure. And by other numbers, in some cases, we see that the average national medical malpractice award, when it goes to trial and there is a trial and an award, is $3.9 million. And that's a number that we got from the AMA several years ago. So even that smaller number would still leave the average physician who suffers this kind of exposure with a $2.9 million personal exposure. And yes, there are many who would argue that those kinds of awards are rare. And the question or the answer, perhaps, to that statement is yes, but what if it's you? Right? What if it's your number that comes up? I also think that you alluded to something else that's exceptionally important. The medical malpractice coverage that you're talking about is purely for medical malpractice, and it does not cover the very wide range of other exposures that physicians have, especially physician practice owners who have liability for employment law issues, for HIPAA, for employee certification, employee classification. Each of these things are risks that I've specifically advised and written articles about. There are many different kinds of risk that are not covered under the scope of your medical malpractice policy. And of course, increasingly what happens, Tarang, is when physicians become successful and start generating some excess capital, they typically move into other areas of business as well. And those businesses might be investing in real estate. It might be being a partner in an imaging center or a surgery center or a lab. All of those have a bunch of associated business owner liability that is common to every other business owner in the United States. And your medical malpractice is sure not going to protect you from that either. In fact, during the recession, the majority of the calls that we got from physicians, both from clients who needed our help, from existing clients, and from people who wanted to be clients, but we had to turn away because they called us too late after the problem arose, had nothing to do with malpractice. It was all to do with general business exposures. That's where all those calls came from during the recession.
That kind of goes along with, obviously, we're at exposure, a wide variety of ways, and not just the medical malpractice, as you mentioned. Just going back to that, though, 1 second, you did say that it is unlikely, but it is possible, correct, to go over that amount. I think that's one of the key things that a lot of physicians are worried about, is that if you are the one who is the $2 million in excess of the $1 million coverage, what are some steps you can do proactively, not when you're sued, but proactively? I don't know if you insure for that, you protect your assets from that, just some basics, nothing specific, but things like that. And then we'll continue on with the non-medical part of it after this.
As you and I both said, I've been doing asset protection planning exclusively for 14 years. Before that, I was the bad guy, meaning I started on the litigation side and started my career like most attorneys, suing people and taking money away from them, okay, which is part of what gave us the background to do what we do, because we know what they want. I will tell you as an attorney that we don't waste time suing people who either don't have any money, which is not the preferred method of asset protection, or who have assets that we can't reach. So the best way to protect yourself is to be in a position where all that is available is the insurance policy, where you can say, to a plaintiff for any source, look, you can sue me and you might even win, but you're not going to be able to collect. And here's what the carrier has offered you, and here's why it makes sense to settle that, or to settle for that amount. Why would attorneys pursue a physician above and beyond the limits of that $1 million medical malpractice policy that we alluded to earlier? Why? Because they have it. We don't work for free. All right? And I'm going to put this in the most simple, predatory business equation terms. We won't waste time suing people above and beyond policy limits where there is no possibility or realistic possibility of recovery. So the key to making your medical malpractice insurance effective and as complete a barrier to that specific claim as the law will allow is to not have a large amount of assets above and beyond that are exposed. And that means keeping those assets out of your personal name and in the name of the right legal structures that have a legitimate business purpose, that are tax compliant and tax neutral, and that make those assets legally distinct from you and your medical practice. So, for instance, you should know how much equity you have in your home and how much of that equity might be exposed to a creditor claim. So, for instance, in Arizona, our homestead is $150,000. In Texas and Florida, it's unlimited. In other states, like New Jersey, it's virtually nothing. This is a state-specific question that every physician should think about. If you've got $1 million in equity or $500,000 in equity in your home, you should think about how much of that might be exposed, and you should think about putting your home into a legal structure that protects that equity. If you have significant amounts of investment accounts and savings that are in your personal name or held in the name of your estate planning trust, like a revocable living trust, those are completely exposed. You should think about putting those into a legal entity that has a legitimate business purpose, that's compliant, and protects them. If you have multiple sources of income, maybe you own a share in a surgery center, a lab, and you own half an apartment building. Well, if you own each of those LLC membership interests personally, and each of them makes income distributions to you as an individual, that income stream is exposed. And so those membership interests should be held by an entity that is not you, the doctor. So I'm giving you some sort of specific yet general examples of things that we commonly see that should not be that way. And those are examples of things that can be easily corrected to take those assets off the table. Remember that attorneys are looking for the lowest hanging fruit, and we love nothing more than cash or cash equivalents. Liquid assets is always the first thing that we're going to be excited about.
Right. Okay. And that's good information there. Now, you brought up a specific point that I think some of my colleagues and I have questions about. For example, a irrevocable trust as not being very protective of our assets. So can you give me a distinction between that, the level of protection that provides versus obviously having your home in your personal name is much less protective, if at all, or versus the other type of trust that I hear about commonly, irrevocable trust?
That is a great and important distinction. And you've actually identified, I have an article called Common Fatal Flaws of Asset Protection Planning. And one of those flaws that I name as my top 10 big mistakes is relying on your estate plan, on your revocable living trust as some sort of asset protection tool. And this brings us back to the distinction between asset protection planning and estate planning. So let's get that clear, because I think this is part of the conversation as well. Estate planning is vital and important. Estate planning controls who gets your assets at your death, who is in control, who has guardianship of your children, who has healthcare powers of attorney. There are 100 different important issues that are addressed by estate planning. And estate planning is death planning, okay? How are the fruits of our entire life's work managed and protected for our family at our death? Many people do that portion of the planning. What most successful people overlook, including physicians, is doing the parallel life planning. How do we protect and enjoy and grow and receive these assets while we are alive so they get to the estate plan, and all that fancy estate planning we did isn't moot, because that estate plan is useless if the assets aren't there at the end of your life.
Absolutely.
Okay. One of the most common estate planning or death planning tools is referred to as a revocable living trust, or a family trust is the term that we hear consumers use very often as well. That is a tool that is basically a sophisticated version of a will. It will help you avoid probate. It'll help your family will avoid the probate process and the public disclosure expense and delay that involves. It will do all of the things that I mentioned in terms of controlling your estate. But during your life, it is zero asset protection against any creditor claim. So we are often contacted by people who have their home, their vacation home, their investment accounts, the membership interest in the LLC that owns the office building. Everything is titled in the name of the Revocable Living Trust, and they are wearing the emperor's new clothes and are under the assumption that having that trust hold title to those assets protects them. And I want to be very clear about this. It does not. The first word on it is revocable, and a judge will simply order you to revoke the trust and tender the assets. So it is an important death planning tool. It is something that most people should have, but just as a scalpel is not a saw, it's a specific tool for a specific purpose. And so it is not that the tool fails, it's you are using it for something you shouldn't be. And I think that's an important distinction. An irrevocable trust, on the other hand, means that once you put property into that trust, it is no longer yours. It is the property of the trust. And if that trust is properly constructed, it's in the right jurisdiction, and names the right people as trustees, it provides a high level of protection for assets if it's implemented well in advance of a crisis. So it's not just using the right tool, it's using the right tool at the right time. And an irrevocable trust is one of many hypothetical tools that comes into play to protect someone. We would use an irrevocable trust to hold certain assets, but not others. In some cases, we would use a tool like a limited partnership to hold investment accounts or own interests in LLCs, another common tool that we might use to segregate things like real estate investments. So, it's a very fact-specific discussion when we start talking about specific tools, because it's got to apply to the circumstances of the person that we're addressing. And my process is actually much like yours as a physician. My process is an exam, a diagnosis, a prescription of treatment, and we have patients that are compliant have very predictable results, and non-compliant patients have less predictable results and outcomes. But a lot of this, if it's done right at the right time, can really produce a very safe and predictable system in which you can move forward and continue to safely accumulate wealth and give you a safe place from which to reinvest that wealth.
Good. Now, one of the concerns that people have about the irrevocable trust is in its name, irrevocable. Once it's there, it's gone, which is great for asset protection, but it implies less flexibility. Can you give me some disadvantages of it prior to a lawsuit or a claim?
Sure. Well, remember that when we do something like create an irrevocable trust, which would be the right tool for asset protection in some cases, the purpose of that trust is to benefit the beneficiaries, the people for whom the trust was created. So, yes, while there is some restriction on flexibility to a degree, any good, legitimate business purpose that is to the benefit of the beneficiaries can be executed by the trust, by the trustee. So in 14 years, I have rarely, if ever, had a circumstance where somebody who put assets into an irrevocable trust couldn't use those assets the way they wanted to going forward. So, for instance, let's talk about a specific example. Let's say that we have a subject that has a high value home that has a significant amount of equity exposed and wants to protect that home equity. Well, if the home is put into an irrevocable trust created for their benefit, they retain the ability to occupy the home. If they decide to buy another home and upgrade that home, the trust can sell that home and either disperse the funds to them for the purchase of another home or use the funds to purchase another home directly in the trust. Also, a properly structured trust would also allow that same individual to keep both the mortgage interest deductions and the capital gains benefits associated with it. And these are all things that we think about, especially for high net worth or high income clients, like many physicians who make a significant investment in buying their homes. I mean, let's face it. If we're going to be blunt, successful physicians tend to buy nice homes in nice neighborhoods that they put time and money into. So this is a concern that most of the people that we talk to have. Also, in many cases, that's not going to be the home they die in. So again, working with an experienced professional who understands and anticipates all of these things is also part of the process. You've got to work with somebody who wants to allow you and who is thinking and drafting, allows you to have the flexibility to use your assets or enjoy your assets the way you want to. And that's perhaps one of the differences between estate planners and asset protection planners. Estate planners are planning for death and are used to planning to give assets away and are most worried about estate tax exposure. But asset protection planners are more worried about what you're doing during your life, how you can use and enjoy those assets, and making sure you retain that flexibility that you alluded to. Does that distinction make sense the way I'm saying it in this context?
Yeah, absolutely. And in fact, I think many of us physicians probably, we think of asset protection, like I was mentioning earlier, only in the malpractice aspect of it. And I'm glad you were you explained that part of it, but you're also talking about the other non-medical portions of it. So I think that's a good explanation. And it's something that I don't think we really think about enough. So, thanks for clarifying that.
You bet. And in fact, I've got a list of risk factors that we look at for people for whom we're doing asset protection planning. And on the list of more than 10 risk factors, only one of them is professional liability. So we have things as basic as, do you own a home? Do you drive a car? Do you have children? Do you have employees? Do you have a spouse or other family members that drives a car or uses property that you are responsible for? Do you serve on the board of a public or private institution or charitable foundation? Most physicians don't realize how much liability board membership carries. Are you selling a business? Have you made representations, financial or legal, that others have relied upon? All of these things are risk factors, and there are many more. But when we give people that list of risk factors and ask them to check off the ones that apply to them, even a guy who says, I don't do anything risky, will end up checking off at least 3/4 of those risks.
Right. Yeah, that's true. Only one is your profession. So even though that's the one we all think about. So those are good questions to think about. Let's go back to one of the factors you said. Do I drive a car? Most of us in the U.S. do drive vehicles, unless you happen to live in Manhattan or maybe Chicago or some of the other bigger cities. We drive. We therefore are exposed to liability. And one of the basic things you hear about is umbrella insurance. It's a basic thing. I don't think enough of us physicians have it or maybe are not covered sufficiently. If you're an average physician, let's say, making $250,000 a year, you own your own home, what kind of umbrella insurance should you have?
I would say that just about everybody should have $1 million minimum umbrella policy. In some cases, depending on the net worth of the client, their exposure level, their visibility level, if they're famous, if their name is on billboards, if it's a surgeon who's, for instance, many of our friends who are in the cosmetic dentistry or plastic surgery business have these wonderful full-page, full-color ads standing with their staff of pretty young women in front of their clinic.
Right.
If you're that person, you have a higher risk profile, obviously, as well, from being simply visible. But getting back to more directly to your question, I think everybody should have that umbrella policy. And I think that people who avoid having it are basically, that is the most expensive $400 a year that you are ever going to save by not doing that. And that is the average cost. It's about $300 or $400 extra per year for most people to add that $1 million umbrella. And we've done some research on this. In fact, I wrote an article specifically for physicians on why having an umbrella policy is so vital and such a basic ground level part of any serious asset protection plan. There are 11 million car accidents a year in the United States that produce on average 40,000 fatalities. Okay? I think that most of us would agree that anytime somebody is killed in a car accident, there's going to be a lawsuit for $1 million or more.
Right.
Right? I mean, and if you have injured several other people or done damage to property, remember that if you drive around today and go into the parking lot of an average shopping mall in a middle class or upper middle class neighborhood, every car is now between $50,000 and $100,000. Every Land Cruiser, every Escalade, every E-Class Mercedes. These are. We're not just talking about luxury cars. Nice cars are expensive, and the property damage and the physical injury claims add up very, very quickly. And we think that this is a vital thing that every physician should have in place. And we think that especially for those who have children and have other people driving their vehicle, perhaps they have domestic employees, maybe you have a nanny, maybe you have a housekeeper who sometimes uses the car, it's even that much more important. It's also important to remember where the end of that policy is. That policy is not a magic bullet. All it covers is exposures related to your home and your automobile. So the other mistake that we see people commonly make, in addition to not having an umbrella, is having an umbrella and thinking that it does more than the company agreed to. All they agreed to do was provide you additional coverage for things that are already covered in your base policy to an extended amount. And that's typically an umbrella over your home and automobiles. It will not protect you from an employee lawsuit. It will not protect you from a data breach at your practice. It will not protect you from 1,000 other things that need to be separately addressed and insured. But it is a vital first line of defense on a very common exposure. And we had a case last year where a physician here in Scottsdale actually got into an accident. His wife got into an accident a year after they canceled their umbrella policy to save $400 a year.
Ugh. Oh, wow.
Horribly injured a pedestrian who was walking her dog. And then these folks went on a fire drill and tried to hide and transfer assets to avoid the liability of the claim because their $500,000 insurance policy that they had in place wasn't enough. At the end of the day, they ended up being threatened with fraud prosecution, which is both civil and criminal, and had to write a check for an additional $600,000 out of their retirement plan. All of that because they saved $400.
Oh, wow. Okay. Yeah. That's one of the things that I remember being told by one of my attendings when I was in residency is get the umbrella insurance. There's just nothing, there's no excuse not to have it. You're, as a physician or a dentist or other high income person, you're a target for a lawsuit. And this is as basic of a must do as you should have. So
you bet. And if we can, I'd like to share one other really important and perhaps life-saving tip.
Absolutely.
With your listeners.
Absolutely.
Many physicians and dentists and other high-income professionals that own their business are told by their CPA to lease or purchase their vehicle through their business so that they can get a tax deduction and write that vehicle off.
Okay.
Right. So for the next 20 seconds, I want you to pretend to be the most irritating personal injury attorney that interrupts your TV viewing every night.
Right.
And I want you to think for a moment, would you rather, if you were the attorney, have your client killed or injured by John Smith, Dr. Smith, or Smith and Associates Plastic Surgery?
I'm assuming the surgery center, because you have much more exposure, much bigger pockets.
That's exactly correct. That's when the casino bells go off in the attorney's office, when we have what is instantly considered to be a deep-pocketed corporate defendant. Leasing your vehicle through your business takes that completely unrelated liability of driving your 5,000-pound missile in between every other 5,000-pound missile on the road every day, multiple times a day, and links it to the single most valuable thing you own, which is your income-producing medical practice, for no good reason. It is among the most simple, stupid, and preventable mistakes that is routinely made out there. Yes, your CPA is correct that you can get a tax benefit, a deduction for leasing it that way. Our advice is to take a car allowance personally, keep the vehicle in your own name, and insure the hell out of it, but don't drag that unrelated liability and hand it to your medical practice on top of all the other liability it already has.
Yeah, that is something I have not heard. So that is very good advice, because you're absolutely right. Almost invariably, the accountants will tell you that to lease it in your company's name. So that it's a very good point. And thanks for bringing that up, because I don't think many of us have ever thought about it unless they've heard you or one of your colleagues speak specifically about that. So that's a very, very important point. Now, I know that we talked about personal liability. We talked about the medical malpractice, and you've mentioned some of the things that practice owners have needed to do. Any additional things that maybe for people who live in, we always think about the East Coast states as being very litigious. Any additional steps that people may need to take that maybe someone in a smaller state may not be thinking about?
You bet. If we're talking about commonly overlooked risk management for doctors, which I think is part of your question. Number one of the exposures that routinely takes doctors by surprise is the risk of an employee lawsuit. Everybody's worried about external threats from medical malpractice claims, but we are not adequately addressing, in most cases, the single largest risk that's common to every business in America, including your medical practices. You are 5 times more likely to be sued by an employee than for any other reason. The average sexual harassment verdict in this country is $530,000. The cost of defending one of these claims out of pocket is routinely in excess of $100,000. Now, why does this keep happening? Because doctors aren't adequately protecting themselves against employment risk, and that really takes a couple of different measures to do that right. The first thing that every medical practice in America must have is a custom-drafted, state law-specific employment manual that controls how employers deal with employees, what the employee's rights are, what the employment policies and practices are. What is our sick time? What is our maternity leave? What if we have a complaint about a supervisor who's not treating us right? What are we supposed to do about it? All of those things should be in a custom drafted state-specific employee manual. We see too many smart, successful physicians making the stupid mistake of getting a free employment manual off the internet, or leaving it to their office manager to source one, or getting one from their buddy in another state and crossing out New Mexico gynecology and writing in Texas cardiology instead. It does not work, and it is, again, a penny-wise and pound-foolish thing to skip. You can get a custom-drafted employment manual from a top source for as little as $2,000 in some cases, and I think it is an important first line of defense. The second thing that is overlooked in managing employee lawsuit risk is something called EPLI insurance. And I alluded to this in your earlier question about medical malpractice insurance being very single line and only covering one part of your professional exposure. This is another part. You must be adequately insured with what we call EPLI insurance, which stands for Employment Practices Liability Insurance, or I teach consumers employee lawsuit insurance. And what that does is two things. Number one, it covers the costs of defense if you have to defend yourself against a claim like this, which, as I said, can easily be six figures. It will also, in many cases, provide coverage against an actual award. If there's a judgment, in some cases, the policy will cover it. So that's one common area of risk management that we see overlooked. Another one inside the practice that we see overlooked routinely is physicians not having adequate data breach or cyber liability insurance. We have, for years and years, insisted that every client we have, no matter whether they are a physician or running a retail store that takes payments, that handles credit card numbers, that handles checks, that has HIPAA protected information, that has social security numbers and birth dates that can be misused, all of that, patient identifying information that all of you physicians have, you have a very significant amount of liability for that. And that should be insured. When I ask doctors, my doctor clients all over the country, to check on how much coverage they have in place in this area, they are often shocked to find that coverage is somewhere between $0 and $50,000. In some cases, if they're lucky, they've got a $50,000 rider in their medical malpractice insurance policy. And let's break that down by using a real example from here in town. There is a dermatology practice here in Scottsdale that turned out to have a young lady who was a drug addict working in their billing department who started using patient credit card numbers for shopping and making purchases online and buying things. And this practice had to go out and inform 40,000 patients in their files that their identity and financial information had been potentially exposed by this woman. So what does it cost to send 40,000 people a letter to them? Is it a buck and a half each?
I mean, and I'm assuming this has to be sent certified or something like that. So yeah, it's that alone is, hitting that $50,000 threshold.
Okay, so then let's add to that the cost of having to also offer all 40,000 of these people credit monitoring for a year at a cost of about $100 each.
Oh. Wow.
So that's another, 400,000?
Right.
So we're at for a potential $450,000 exposure without anybody actually suffering a loss or even making a claim. And that could have been addressed by an insurance policy that costs about $2,000 a year.
Wow.
Now, these are the kinds of things that we go through with clients when we're doing their risk management portion of their planning. As I said, remember one of the very first questions you asked me is, what is asset protection? I said it's 3 layers. It's not doing things that get us in trouble. It's having all of the right kinds of insurance to the right amount, which means more than an umbrella, more than a med malpral policy. It means having all of these other things addressed as well. And having somebody go through this list with you and say, hey, these are the things you're missing. Here's where you should go buy them. That's part of asset protection planning too.
Right. Well, listen, this was, I think we could talk all day because I have tons more questions, but I think this is a good stopping point here. Let me ask you this, and I want to thank you again for all this information. And I feel like we'll probably have to have you on again to sort out some additional questions that our listeners will have for you. So thanks for coming on, Ike. I appreciate it. Tell me and our listeners where they can find more information about you.
Sure. I appreciate that. It was a pleasure to be with you today, and I'd love to return and talk about these issues in some more detail. For those of your listeners that want some more information about me or about any of the topics that we've discussed, I have a great educational resource. My website is proassetprotection.com. So that's PRO assetprotection.com. I have a section on that website marked articles, where you can see some of the 300 plus nationally published articles that I've written for physicians and medical journals. And I cover many of the issues that we touched upon today there in great specific detail. And I'm happy for any of your listeners to have that educational resource so they can be better protected.
Great. Well, thank you. I'll put a link to those on our website and our show notes as well. But once again, I thank you very much. This was very informative. Learned a lot of stuff that I think we don't think about other than the standard, basic issues that physicians talk amongst themselves. And we're missing out on quite a bit. So appreciate you pointing out some of those things. And I encourage all of our listeners to go to your website, read some of your articles, and ask questions to you or other attorneys who specialize in this about things that they're missing in their own protection. So once again, Ike, thank you very much. Very informative, and we look forward to having you back on our show at another point.
Sounds great. Thank you.
I want to thank you for listening to episode 3 of the Dr. Money Matters podcast. Thanks again to my guest, attorney Ike Devji. I think Ike did a great job explaining the importance of proactively protecting your assets. I learned quite a bit today and hope you found this episode informative also. Look for more information at his website, proassetprotection.com. If you enjoyed this podcast, please leave a positive review on iTunes, Google Play, Stitcher, and let your colleagues know about this show. If you have some constructive criticism, please send an email to comments@drmoneymatters.com. Again, that's all spelled out. Please remember what you've heard on this show is for your entertainment and education only. Speak with the appropriate experts prior to making any decisions regarding your own financial situation. Just a reminder about the new feature on our website. After you listen to each episode, go to the drmoneymatters.com website to answer a couple of simple questions regarding each episode and get a certificate of continuing education, which is not sanctioned by anyone and is completely fake. But hey, it's free. Next up on episode 4 of Dr. Money Matters, we speak with Anjali Jarawala, CPA from Fit Advisors in Southern California. She specializes in tax issues and financial planning for early to mid-career physicians. Anjali will provide us with some good information regarding taxes, which are most healthcare professionals' number one expense.